Good morning or good afternoon, everybody. My name is Orlando Smith. Welcome to my Road to Financial Freedom. Can everybody hear me well? Do I need a microphone? Can you hear me?
I can't hear you back here.
Well, yeah. So today we're just going to do the introductories about getting started in investing and what you have to do before you can start investing. Because there's steps you have to take before you start investing so that way it does not mess up your investments down the road, right? And you can go to the next slide. Generational wealth. What do you think generational wealth is? Anybody out here? I accept participation.
When my mom and my dad left me with all the money they didn't have.
Yeah,
I agree.
that's in a sense what generational wealth is. It is when you accumulate assets, whether that's money, property, investments, or other financial resources, and you pass it down to your next generation, and then their kids, right? And the way to build generational wealth is first you have to improve your financial literacy, right? So you have to know exactly what's going on with your money and how you can make your money make money for you. That's the first step to building that generational wealth. The second step would be to not only educate yourself, but you have to educate the generation after you. Because people has built generational wealth, and 60% of the people who pass it on to their kids, that generational was gone, that next generation. And then about 90% of the generational wealth is gone in that third generation. So your grandkids, they'll be your generational wealth that you worked for, right? Only about 10% of generational wealth continues to go past that third generation. So we have to instill financial literacy into ourselves so that we can pass it on to our kids. They can pass it on to their kids. The same way you teach them, respect elders, hold the door for women, and the things you teach them the financial literacy, so that way it's instilled in them the same way you instill other lessons to your children. And the third thing is don't wait to invest. That's the biggest thing. I used to try to get people to start investing, and they'll say, well, I don't have it right now. I'll do it next check. I'll do it in a couple years when I can get a little more money on me. But I'm like, in a little bit more years, whatever you're trying to invest in or you could invest in now is a lot more expensive now. If you look at the stocks back in the 80s, they might be like $10. And that same stock today, if it survived, of course, could be thousands, hundreds. Houses in the 80s might have cost you like $50,000. That same house today costs $230,000 for the same exact house, right? So don't wait to invest. Get started as soon as you can. So now is the best time to start investing. Yes, it may seem a little expensive, but it's very much possible. This could be the cheapest that you ever see it again. You didn't think back in the 80s when the house was $50,000 that might have been expensive to you. Because to your parents, they might have bought it for $30,000 or $10,000. But now looking back, you wish you would have bought a couple more houses when it was $50,000, right? It's the same way now. Yes, it might be $200,000 now, but when your grandkids are older, when your kids get older, that same house might be worth $400,000. So it's very much possible that right now is the cheapest that we'll see it. Next slide. we have to do is reprogram your mindset with money, right? So in order to do that, we have to forgive our past financial mistakes. That's the biggest thing. We've all made some financial boo-boos on the way to where we are now. You may have just excessively been buying things that you didn't need, excessive credit card debt. I don't know what you may have, but you know. And so you have to acknowledge the mistake. Realize that, hey, I've made a mistake financially, and you can't ignore it. Because if you ignore it, then that financial mistake, it grows. And it's going to continue to grow. Because you're looking past it, but it's trailing on behind you. If it's, for example, credit card debt, you might say, I have it, but I'm not going to pay it. Now it's just accumulating interest. Now it's just add more money that you owe. So you can't ignore problems, especially financial, thinking that it's going to go away, because it's not going to happen, right? And you have to learn from it. You acknowledged it, you're confronting it, now you have to learn from your financial mistakes, so that way you don't fall into that cycle again. You don't continue into it. Because if you ignore it, especially credit card debt, you're probably going to keep using that credit card. So now the interest is building and you're adding on to it. If you're excessively spending on things you don't need and you just ignore that problem, then you're going to have more Amazon packages come, and more Walmart packages come. And then you're going to realize, like, why am I living paycheck to paycheck? It's because you just bought 30 things off of Amazon this check. Or you're just running your credit card up. So we have to learn from it so that way we can focus on the future and how we can eliminate these boo-boos or these financial mistakes and move past them. That's the first part about reprogramming your mind on money. You have to understand as well your thoughts and emotions with money. Some people, they get emotionally attached to their money. Maybe they grew up in a low-income house. Maybe they came up in a house that had money, but then saw a financial issue, for example, like the 2008 housing crash, affect their family. So now they're like emotionally tied to money. You cannot get emotionally tied to money because money is not emotionally tied to you. When people are on their deathbed, they don't be like, oh, I wish I made more money. They say, I wish I spent more time with family. Or I wish I would have did this or went this place, because that's what matters. Money is not the goal. If money is your goal, you will never reach your goal. Money is a tool to help you reach your goal. So maybe your goal is early retirement, or living well in retirement, or buying a house, paying off all of your credit card debts. That's what your money is for, to help you get to those goals. So don't get emotionally attached to money. The rich doesn't. The ones who are already rich, they know how to use money to make money for them. The people at the bottom in the middle class, it's like we're working for money. We're not working towards our individual goals. So that's how we got to reprogram our our mind, and how we view money. Another thing in life, especially when it comes to finances, you do not compare yourself to anybody. You cannot keep up with the Joneses or the Johnsons. The Joneses they got too much money, right? But you should only be comparing yourself to yourself. You don't want to be in the same position that you were in last year. So at that point, you're getting stagnant. Some people are comfortable being stagnant. But you have to continue to grow and compare yourself to yourself. Right? And when you see what other people have, Just because they have it doesn't mean that's for you, right? Because first of all, their blessings are not your blessings. And if you go and try to get their blessings, now you're probably walking the opposite way of where yours is, trying to get what somebody else has, and that's not meant for you. So you don't have to keep up with the Joneses. Run your race. It's a marathon. It's not no quick sprint. It's a continuous thing. Because they may have already reached their goals, especially in this time with social media, right? People are not going to post their downfalls. They're only going to post their highs. And if they reach their goal already, everything might seem like a high, but you don't know what they went through to get to where they're already at, right? So don't compare yourselves to their highs only, because you don't know exactly what they're going through, what they've been through, or even how they got that money. That might not even be legally obtained, but we're not going to go there. Thank you. So the next thing to reprogram your mind on money is work on forming good habits, because that's going to be where the change comes from. Creating a budget, big thing. Everybody should do that, whether you're rich, medium income, low income, government assistance. Create a budget so that way you can see where's your money going. Next, emergency funds. Pay off bad debt. Create financial plans. Because if you don't have a plan, then what are you doing? You're just running a race at this point. You don't know where you're going or how you're going to navigate it. Another thing, life insurance. A lot of ways that these upperclassmen have received their wealth is through life insurance. They pay maybe like $50 a month or something, I'm not sure. And they have these $1 million plans. So if they pass away, now my family doesn't have to worry about asking everybody for money for the funeral stuff. The funeral's paid off. I got enough to pay off all my bills, the house. So now that sets your family up to thrive even without you, because your biggest asset in your life is your ability to make money, right? Because without that, there's no income coming in. And when you pass away, if you don't have any life insurance, then your family is left with the bills that you've racked up, house payment that some people may have refinanced, so now the payment is higher, and they started over their 30 years. So life insurance is definitely a tool that is used. And if you get certain plans, they even allow you to borrow against your plan. Instead of having to go out and get loans for things, you can borrow against your life insurance and just pay it back to your own life insurance. If you don't have life insurance, I do have somebody who does our expertise in life insurance. So you can get with me after the class, and I can give you the information, and then they can walk you through what process or which plan is best for you and what you're trying to do in that manner. And then the last thing about reprogramming your money mindset is be thankful. Be thankful for what you have, because that's what's meant for you. You can get more in the future. You can get less in the future, but be thankful for what you have, because at any moment, it can be taken away from you. There's people who are in worse financial positions than you, just like you're in worse financial positions than other people in the world, right? So be thankful for what you have. You can go to the next slide. I do have information on some companies, locally and globally, life insurance for sure. And I'm talking to people on the live as well. We have people on the live and people in the audience. So this next slide, I know the people on live can't see it, is budgeting. And it deserves its own slide. It honestly does. Because budgeting is the key to achieving your financial goals. Right? You can't see how to save and invest if you don't know how much money you have. And I had that problem too at first. Because I would just get my paycheck and I would spend it. And then once I started doing a budget, I seen how much free money I had. But then when I was looking at my paychecks, I was like, wait a minute now, this is not correlating, right? So at that point, you can see how much money you actually have, and then you can, at that point, have your money work for you. Whether that's paying off debt, investing, creating emergency funds, it helps you at that point. So with the budget, like I said, with this excess money that you find out that you have, you can pay off your debt. There's three ways, main ways to pay off debt. That is a debt snowball, which is a debt reduction program or strategy where you pay off your smallest bill. And then that money from that smallest bill, once you paid it off, you put that to the next smallest bill. And then you'll pay that off. And then you put both of those funds into the next one. And it just continues to grow like a snowball. Therefore, it's a snowball effect. Right? The second one is a debt avalanche, where you pay off all of your debt. And whatever extra money you have, you put that to the one with the highest interest rate. And you continuously do that. Because that high interest rate is taking a lot of money out and it's eating at your pockets and your finances. So as you dump money into that one, it'll get rid of that high interest rate. And you'll have a larger lump sum once that's finished paid off. And then you go to the next highest interest rate and pay that one off. That's called the debt avalanche. The debt consolidation is when you roll multiple debts. Say if you have multiple cards or like a car note or something like that, and you put all of those into one credit card that has maybe 0% interest for a little bit, or at least a lower interest rate than other credit cards, so that way you're saving money on the amount of payments that you're making monthly. So you might have $30 here on this credit card, 50 here, 60 here, 100 there, then you consolidate them, your bill might just be $80. Right? So you're saving money that way by consolidating. A lot of people who have homes, not a lot of people, but an option is the home equity line of credit. Some people, they take equity out of their houses to consolidate their debt, but be sure that you do pay it off as well with any debt that you have. But that's an option that some people do. Of course, I'm not a financial advisor, so definitely speak to your own personal financial advisor when it comes to which route, and even your spouse, which route is best for you. Whether that's consolidating your debt, doing a debt snowball where you pay the smallest one off first, you can continue up higher from then, or the debt avalanche, which is taking care of the highest interest rate. You know your cards and your debts, you list them out, and then you figure out which one's best to tackle from there. With the budget, once you see all of your bills and everything that you owe compared to how much you make, you can make better decisions at that point. Because now you can see what you're spending your money on. Like when I did it, I was spending my money a lot on eating out. Right? And so at that point now I know I can cut back on eating out and maybe try to grocery shop a little bit more. That saved me some money in my pocket. Or you might see that yours is, you might go out a lot. Maybe that's vacationing, or maybe that's just leisure activities. And you're just spending an excessive amount in 2 weeks on that, right? So at that point, with that budget, you can see where you want to cut at, where cuts can be made, so that way you can put those funds to use for you, rather than just using them. Another thing with budgeting, since you have ways where you're cutting things out at, you can begin to make your emergency fund. You want your emergency fund to at least be able to cover your main bills for at least 3 to 6 months, like your mortgage and maybe your car note, right? Because if anything happens, you have that emergency fund where you can pull out of, rather than having to go into your investments and pull out money from there. Because I had a friend who was investing, making a lot of money, and he hit a little financial snag. He had to basically liquidate his entire portfolio to cover his emergency that happened. And in order to prevent that, it's best to get that emergency fund started off rip before you really get into the investing part. And then as well, you don't want to hit an emergency and then have to throw that onto your credit card and then get hit with interest because you had an emergency. When you have an emergency fund on the side, then, like I said, you can just dip into that. And then just replenish it once you can. The budget helps give you control over your money and where it goes. Because at that point, money isn't just being wasted. You know exactly where your dollars are going to. When you have no budget, you just swipe your card. I got more money in the bank. I got it. You'll check your account, 200, swipe. So it's best to have that budget, because then you get a little bit smarter with your choice. Like, yeah, that's a little $20. That's 10% of what I have left. Let me. I don't need that cup of coffee. I don't need those snacks right now. I'll do without it. Yes.
On the emergency funds, is that in a bank account, or is that like stashed somewhere?
So I like mine to be in a separate savings account away from my money, just so that way I'm not, just hitting a little transfer button on there. You can put it in a CD account, and that way it'll gain interest for you. You can't touch it out that CD until it expires or matures. And then you have the high yield savings accounts as well that you can put them.
Where do you put emergency?
Yeah, where do you put your emergency funds at? Yes, you don't want your emergency funds in the same bank account as all of your bills are coming out of, and nor the account that you spend or your debit card is linked to.
Now, can I say something?
Yes.
The high yielding interest accounts with your emergency funds, that's a account that you won't be just going in there.
Right.
It'll be there for a minute until an emergency comes. Well, the high yielding interest accounts, a lot of them is paying close to 5%. And so that's a pretty good return on money just sitting there. And you can get it when you want it and not be penalized like a CD would penalize you. So, the high yielding interest to me is the way to go. That's what we put ours in the high yielding interest.
Somebody asked an example of a high yield savings bank. I believe SoFi has high yield savings accounts. American Express. I think most banks and credit unions have high yield savings accounts. You just have to actually either go on their website and look it up, or you can just call them and they'll give you the rates. And I believe some of the banks though do require like a minimum deposit. Yeah. So as well, look into that, see how much the minimum deposit is for the high yield savings account.
Well, I know with American Express, they just ask $5.
American Express is $5, which isn't that bad.
Yeah.
American Express, is that a bank?
It's a bank.
That's the bank.
Here in Jacksonville?
It's global.
It's global bank. You can call them up, they'll set you up.
American
Get your
Express.
account going.
Okay. So not just a normal savings account, a high yield savings account. And they ask why a savings account when it doesn't bring back no interest. A high yield savings account right now is giving out roughly like 4 to 5% interest. But if it's in a normal savings account, you're not getting.
Not even a percent.
Yeah, you're probably getting like a penny or 2 pennies or something like that.
0.1%.
So another way to build this wealth, now that you have the budgeting down pack and you have the mindset a little changed about how you view money, is let's bring in multiple streams of income, which is something that is very common in the wealthy, right? Your main stream of income, I'm assuming for everybody here, is your job, right? Or retired. And then your second, if you were married, would be your spouse's job, unless they're retired too. But other than that, we have to find another source of income, right? You're not going to get rich or get wealthy or build generational wealth with just having your 9 to 5. Your 9 to 5 is only going to pay you to help the company you work for build wealth for them. What you do outside of their doors, they don't really, that's up to you. But they are draining us in a sense. And once you get done with your job, you're not trying to do anything. You want to go home, you want to watch TV, you want to relax. But we have to build multiple streams of income. Some examples on here is real estate. You can get your rental property going. If you have the time and resources, you can buy a house and flip it to bring some more income in. Stocks, which is investing in the stock market, which is I'm going to break it down a little bit in this class. And a part-time job. I heard, I mean, you got things like Uber Eats, DoorDash. But it's just to bring in some extra money. You got online businesses. You can sell stuff online, publish a book. There's so many ways in today's times where you can make money. They make money from making videos on YouTube and playing video games on YouTube. There's kids on YouTube who opens up toys and say, I like this toy because such and such. And other kids watch it and they get millions of views. And they get paid from it. So in today's time, there's so many innovative ways you can make money. Right? So we have to find another way to bring more income in. Because maybe with your budget, most of your money is going towards paying off debt or something like that. That second source of income or third source of income, that could be money that'll even expedite that process of eliminating that debt. And if it is eliminated, that could be more money you put into your investments, whatever that is. Right? Because have you ever seen a table with just one leg underneath it and it's like supporting that table? If that leg is taken out, then there's nothing supporting it. The table's going to fall. And everything that's on top of it is hitting the ground. If you have a table with 4 legs and you take one of those legs off, the table might be a little wobbly, but it's still going to stand. It's not going to fall. And that's the same thing with your income. If you only have one source of income, and Lord forbid, if something happens, like a layoff or you get fired, I mean, you have your emergency funds hopefully for like 3 to 6 months, but you need something quick. If you have those other sources of income, you still can survive while you find that other job. Right? Next slide. preparing to invest. So everything we talked about so far was like pre-preparing to invest. Things that you need to consider before you even start considering investing. Now, to actually what to do to invest. You need to find out what you're investing for. Are you investing to retire? To live off of passive income? Just have money come in every month so that way you don't have to depend on what Social Security or your 401k. You have another source of income coming in every month. Are you trying to pass down funds to your grandkids? You need to find out what you're investing for, your own individually. After that, you need to determine how much you can afford to invest. And that's when you look at your budget and you see how much free money that you have. What can you afford to invest? When I first started investing, I literally started with $20 a paycheck. It's not a lot, but it's less than a meal at a restaurant, which, like I said, was one of my biggest issues at the time. And with me, what I found out is it's best to pay yourself with your investments right after you pay your tithes. You pay your tithes first, and then you pay yourself second. And then you handle those bills. Because if you pay your tithes, and then you pay all your bills and stuff like that, and try to, whatever I have left over at the end of my check, I'll put it in my investments, it probably won't happen. And if it does, it'll probably be like $5, $10. I just throw this little change in there. So do it in the very beginning. Pay God, you pay yourself, and then you handle your bills. Because the bills are going to be here regardless. But you got to take care of yourself. And people always ask me how much do they need to invest, and I always tell them, and I always lose them at this point too. I say, however much you can afford to lose. You don't invest anything that you're gonna need in the next 6 months. So don't go and be like, oh, I'm gonna put $1,000 in this, I'm gonna flip to $2,000 in 2 weeks, and I'm gonna get my money out. Yeah, you're probably gonna lose $1,000 real quick, right? So invest as much as you can afford to lose. And that's why when I first started, I was putting $20 in, because if I lose $20, I mean, cool. But then as I continue to do it, at $20 turned into 100, and then a couple hundreds, then some thousands, right? So it grows quickly. And then as you get comfortable with it, you'll start putting more money into it. Because now you're understanding what's going on, and you're seeing the return that you're making, right? As well, find your risk tolerance. Are you trying to be like a high risk, high reward? You want a medium risk, or you want low risk? There's all these in the stock market. I'm going to go over those in a little bit. But you got to see what kind of investor are you trying to be. And it's the same with any market. If you're doing the housing market, you got to find out what kind of investor you want to be. Do you want to do rental properties? Do you want to be flips? Do you want to do wholesaling? So you got to find out what kind of investor you want to be. And then find your style of investing. Like I said, you do real estate, stock market, private equity investing, art. There's a whole bunch of things that you can actually invest your money into. Choose an investment account, right? So when you're choosing an account, are you going to do this in a 401k, a Roth IRA? Are you going to just let your employees do it? Your employer do it for you in their 401k program? Are you doing a custodial account, which is for your children under the age of 18? You'll just create them an account and you'll invest for them. So you just got to figure out what kind of account that you want. And then you got to pick a broker, which I'm going to show as well. You got Webull, Robinhood, Charles Schwab, Fidelity, E-Trade. there's a lot of different brokers that you can use, and some of them are a little bit more advanced than others, and some of them are beginner friendly. Yes, sir.
Can you explain the job of a broker? What do they do exactly?
The broker is the middleman. So if I'm selling stocks and you're buying stocks, they're facilitating it for us in a sense. They're making sure that the buy orders are filled and the sell orders are filled. So they're the middleman that's going to control what's going on in a sense. They take the money that you put in there and they actually buy the stocks for you. Because you can't just go up to the person down the street and say, hey, let me get your stocks from you and buy it. So you go through the middleman, which is the broker.
So with this broker, apparently there is a fee or a percentage that broker or brokerage firm would get. Is that negotiable or is that a set amount?
It's not negotiable, but as of 3 years ago, there was a brokerage wars because we had a newer broker called Robinhood, and they had 0 commission fees. And once they did that, a lot of the legacy brokerages like Charles Schwab were losing a lot of customers. So then, for the most part, every broker has gotten rid of their trading fees because it was at one point like $7 to trade. But for the most part, all of them has gotten rid of it, in the exception of penny stocks. So if you're buying like a stock under $1, they'll still charge you like the $7 to buy that, and it's not negotiable. But other than that, they're mostly free. Then, how are you going to fund your account? Is it going to be a cash account, or are you going to borrow money? All of my accounts are cash accounts. I don't want to borrow any money. I don't want them saying, hey, we're shutting your account down until you pay us back. I use my own money that I put in there. Okay? And then, next slide. Are you going to monitor your own portfolio, or would you rather just give it to the broker and let them facilitate your transactions for you? They are trained. They went to school and got degrees for this. So,
Can't you not let them handle it and get you monitor this? My question, like my job goes through Fidelity, right? So I kind of like leave it alone because I don't know what I'm doing anyway, right? But I want to know if they're making the best decision for me, or is it they're making the decision for them to get what their commission or whatever it is. So how do I know where they're putting the money that I put in?
you can reach out to your, I want to say, human resources department, and then they'll give you the information for, or if you go, I don't know if they should give you access to the Fidelity, and you can ask them for your statements. And they'll give you a statement, and they'll let you know what ETFs they're putting it in, and what individual stocks are putting it in. And they'll let you know, like, what percentage you own in each stock. But you have to ask for it. If you don't ask for it, then they're just going to keep investing. But yeah, and even with my job at Citibank, they asked if I wanted to adjust where they put my money at. And so I manually adjusted where they're putting my funds at. And you can check if you want, but they should allow you to do that as well. But if not, then they're just going to do it. Yes. Correct. Any other questions so far? Okay. So the stock market. The stock market is a network of stock exchanges where traders and investors, they buy and they sell their shares of publicly traded companies. So if it's a public company, they are on the stock market. You can own part of that company, right? two of the biggest ones in the world are the New York Stock Exchange, which is right there in New York City. And the second one is the National Association of Securities Dealers Automated Quotations, also known as the NASDAQ. Right? The NASDAQ focuses morely on technology stocks. They do have the other ones in there as well, but their main focus is technology. Because technology is what's moving America forward and the world forward. The stock market is open from 9:30 in the morning to 4 p.m. in the evening, Eastern time. Right? Some brokers offer you 24-hour trading, but not all of them do. And then what are brokerages? And I explained to you, they're the middleman. They handle the transactions that you place in. If you want to buy, hold, sell, they handle those for you. The stock market serves two important purposes. It helps the companies raise money. That's why they went public, because they want to raise money. We're selling you some of our company so that way we can bring more money in. And then they'll use that money to push their company into the future. Whether that's expanding or whether that's just reinvesting into themselves. The second thing is for us to give investors an opportunity to share in their profits with them. So you want to make sure, for the most part, that the company is profitable. Or else they're going to be losing money, you're going to be losing money. A stock represents a share of ownership in the company. And when you own a part of that company, you have access to some of that company's earnings and assets. So when they make money, you make money. When you own a stock, you own a portion of that company, and with that, they allow you to do things such as vote. For example, if the CEO of the company wants a raise, he's going to say, all right, everybody, I think I deserve a raise. I done made X amount of billions or millions for this company. I want more money. And then they're going to send you a text message or email saying, hey, it's time to vote. Do you think this person deserves a raise? And they're going to send to everybody who owns a share of the stock. Do you think this person belongs to stay on the board? And if you've been paying attention to the stock, I mean, you can make that vote. If not, you don't have to vote. They're not going to take your stock because you didn't vote. But you have that chance. That's like you sitting in the boardroom with them, in a sense, making the decisions. Next slide. And it says, why should you invest now? There's more tools available now than it's ever been. Back in the 70s, they didn't even want small portfolios in the game. They want you to have thousands of dollars. They just want you to give it to them, in a sense. They had the high brokerage fees. You know why? To keep the lower class and the middle class out of the game. But that's changed now. We have websites where they break down the charts for you. If you like to trade by the charts, they have websites that gives you the information on the companies that you like and that you own. They're like, hey, this company, they're producing a lot more money this year, this quarter, or this company is losing a little bit more money than they usually do. There's zero trading fees. They have robot investors where they just kind of go about where you want them to go. And they have paper trading now, which is like a real account, but with fake money. So that way you can get a feel of investing and trading without using your actual money. Right? Like I said at the beginning of the class, there's a strong possibility now that the stock market is cheaper now than it's ever going to be in the future. If you look at this chart, which is zoomed out. If you look at the S&P 500 on your phone, just type in S&P 500 chart and go to the max. You see in 2003, right there, on those two humps, that's the highest it's ever been at that time. I want to say that was 2007. The stock market was at an all-time high. And you're probably looking at it like, oh man, that's too expensive, right? And it dropped because of the 2008 housing market. But now look at it 2024 compared to where it was then. It's at an all-time high again. And you're looking at it now like, oh, that's expensive, man. But then 2040, that might just be one of those little humps in the back at that point. So it's a strong possibility that it gets more expensive, just like everything else. You know, eggs was a little cheaper 2 years ago than it is now. I know a lot of y'all could have bought a whole book bag full of candy with $2 back in the day.
Bread was $3 for
$3-4 for bread. Now you get what?
$4.99.
Yeah, for a piece maybe. And the average return on your investment in the stock market with the S&P 500 yearly is 9%. And that's just put it in a SPY and just let it sit. You, on average, get about 9% return on your interest. And
Excuse me.
yes, sir. Yes, ma'am.
So, is that, the average is 9%, is that over what period of time?
That's all time with the stock market. Every year divided. That's just annually you receive like roughly 9% interest. Now, some years it might be a little lower. Some years it might be a lot higher. But on average, when you average all your years, you'd be around 9%. Your cash loses value when you don't invest it. If it's just sitting in your normal checking or saving account, you're getting pennies on the thousands of dollars.
Right.
I was watching the show, well, my wife was watching the show, and I was listening, I was in the room. And there were these millionaires who's like, man, we were happy when we finally hit a couple $1 million in our bank account. And we looked in our bank account and we saw we was getting $200 in interest on our millions of dollars. And it was like, we need to do something with this. We need to make this make money for us. And if you don't have millions of dollars, then you're definitely not getting $200 in interest on your normal checking and savings account. And then with interest rates going up, you're just losing value with the dollar. It used to be buy chips 2 for $1. Now it's 2 for $1.30. Right? So it's just losing value just by holding it and not doing anything with it. So the S&P 500 would definitely help you stay ahead of that interest rate curve. Next slide. So there's different categories when it comes to the stocks in the stock market. You'll see it when you start to invest yourself. Small cap, and cap is the capitalization. This is pretty much, the cap is how much the company is worth overall. So you have small caps, which is the company is less than $2 billion. Mid cap, the company is between $2 billion and $10 billion. And then large cap is over $10 billion. Right? And then you have different sectors in stocks. Healthcare, you have automobiles, you have financial services, computer goods, e-commerce, anything you can pretty much think of, they have a sector for it in the stock market. And then you have, well, before I go back, let's go back to the company size. The small caps are a little bit more risky. Those companies aren't, they're not the big dogs. That's not Microsoft. That's not Google. That's companies that's probably like 10 years old, maybe less. They're trying to carve up a way into the market, right? They might be game changers in the future, but right now, they're just real risky. High risk, high reward. That's those. They're young and they're growing fast. The mid cap, they're kind of steady growers. They continuously increase their profit. They continuously grab more market share, and they're continuously productive, right? So if you're looking at their curve going up, they're in the middle. So they're not starting off like the mid caps. They're like in mid growth right now. They're still growing. They still have a ways to go before they want the big dollars. So they can provide the growth in your portfolio. That's the medium risk ones for the most part. And then large cap is the significant portion of the U.S. equity market. The large caps are often the main part of many people's portfolios. Like if you have a 401k or if your job is investing for you, majority of it is probably in the large cap stocks because that's what America's kind of like built on in a sense. They're stable companies, very impactful. They're going to pay dividends, and they're transparent. So if they're losing money or something's going on in the company, they're going to tell you. Small caps, you might not ever know they're struggling. Some of them might not even report earnings on time. But the large caps are like Google, Apple, Amazon, Nvidia, stuff that you know. So a lot of people like to base the large chunk of their portfolio on the large caps. So you have different types and strategies. You have growth stocks, dividend stocks, and value stocks. Then you go to the next slide. I'll go into a little bit more detail into it. So the first one is active investing. That's when the person takes on the most risk. That's when they're buying a stock and they're going to watch it every day, every week as it grows. And then once it gets below where they want to, they'll sell it. So active investing, they're actively watching the stock all the time. Watching the movements and the patterns. The second one is passive investing. That's like when you have your employer investing for you. And they're doing like your 401k, that's the passive investing because they're doing it for you. You're not watching the stock market, you're not watching the stocks, they're doing everything. Number 3 is the growth investing. And that's when you're investing in companies that you believe are going to grow. They've been doing good on their earnings, they've been making money, and you know or you have believe that they're going to grow. Another one is value investing. Value investing is normally when good companies trade at a lower price than where they should be at. So say for instance, Amazon is normally at $400 and then it drops to like $300, maybe $250. At that point, that's a value for it, a value stock in a sense, because it shouldn't be that low compared to where it's normally at, but it's there for now. So that's like a value investing. Buying great companies on lower prices. Number 5 is, yes.
Value investing.
Yes.
How often do you find that? Is that something that's, you can find that quite often?
You can find it quite often. It might not be with the major stocks, the main 7 stocks all the time, which is Apple, Nvidia, Google, Tesla, Microsoft. It might not be with them all the time. You can definitely find some great value investing in other companies. Sometimes you might find them in the banking stocks. Sometimes you find them in like healthcare stocks, like Walgreens sometimes. So it's really just looking at it, and then you compare like their value to their other people in their sector. So if everybody's been trading at a rate, say for instance their PE level, the price to earnings level for everybody in healthcare is at 10, and then Walgreens is at 5, but it's normally at 10, then the price is probably lower as well. So it's like, okay, now that's a little bit of value. Because you know Walgreens is a well-known company. The business model hasn't been changing like that. So at that point, you're getting a value on that stock. But it happens a lot. But you have to be looking for it, though.
Is it a certain place you look for that?
You can go to some stock screeners like FinViz, and they'll let you know what are some of the value stocks. Sometimes you can just go on Google, type in value stocks, to give you a list of the current value stocks. But definitely do your research before you just put your money in anything you read online. Because sometimes they're just pumping the stock. And once it makes money, they're going to sell it and leave you holding the bag. So you want to make sure you do your research on it. Because at the end of most articles online, they're going to say, yes, this company is good, but we have 10 more that's better for you to buy. Most of the time. And then they're going to throw on to more stocks that are value stocks that they think is good for you. Right? Yes, sir.
So would you recommend, I'm not gonna say the word recommend, but what do you think about the banks that do the investing for you? Example, Chase and Navy Federal, you know, they have sectors where they can do investments for you.
If you don't want to look at it yourself, they're definitely great options to do. You want to see what their average rate of return is for them. And if you feel like it's a great rate of return, then definitely go with them. Let them do it for you. I think one of the top investment companies is they have the Morningstar. It's not Fidelity. It's where Peter Lynch is. I just went blank. I'll get back to you on that one. But yeah, if you don't want to watch the stock market, and you don't want to put the money in individually and buy the stock yourself, that is a good option. They're gonna do the job. They get paid for that, and they're gonna try to make some money off of it as well. So definitely check out their rate of return, and if it's good annually, then I would say go for it, for sure. So indexing, number 5, is you just buy ETFs in a sense. An ETF is an electronically traded fund where you just get a whole basket of stocks and put it into one. So you might buy $300 for the one ETF. You might get 3% of it is Amazon, 3% of it is Netflix, 3% of it is Amazon, 3% is Walmart, 3%, and it just goes down. So you're buying one share, but you get multiple companies in the ETFs. So a lot of people, especially when they don't want to individually pick stocks, they just buy the ETFs. Like the S&P 500, it covers the top 500 stocks in America, 500 companies in America. The NASDAQ, yes,
What is the ETF?
electronically traded fund, ETF. Yep. You got the
I see a lot of people doing that right now.
Yes.
So is it a high risk, or is it whatever you want to get out of it, you invest whatever you.
Mm-hmm.
Okay.
I think something is like that because I didn't know what the select, high risk, medium, whatever it was, and I was just like, cause I don't know.
Mm-hmm.
And, that's something with Fidelity, right? So I think he did put in something where my dollars are split
Mm-hmm.
into different companies.
Yeah, I think with the 401ks, and then when you have somebody do it for you, they're more than likely going to put them in like an ETF. So that way you're spread out. So that way if Netflix drops 10%, your whole portfolio is not dropping 10%, but you have a couple other, maybe 20 to 50 other stocks in there that's going to hold it up. right? So it is less risky because you're more diverse in there. And then they have ETFs for sectors as well. So the S&P 500 is the top 500 companies in America. The NASDAQ is mostly tech stocks. But then say for instance you like electric vehicles. You can go to an electric vehicle ETF. So the ETF only has electric vehicles in there. They have stuff like cloud computing in there. So you can just do nothing but cloud computing ETFs. So they have different ETFs you can do as well. Doing an ETF over the entire market is pretty safe. It's not guaranteed that you're gonna make money, but it's a lot safer than just buying one stock. Number 6, the buy and hold strategy. It's the most common strategy that people build wealth in. They just buy the stock and they just hold it. Imagine when we had the chart up for the S&P 500 from 2000 to now. Imagine buying a stock in 2008 and just holding it to now. How much money that? Imagine buying Apple in 2000 for like $10. You just held it. You make thousands of dollars off that $1 $10. And imagine you putting $100 in there. Where would it be now? So that's one of the most common strategies. Is just buy and hold. Makes a lot of millionaires off of that. Market capitalization strategy. That's when, and if you remember, we talked about the small cap, mid cap, and large cap. You base your portfolio based off of the cap size. So if you want to be real risky, you might invest in like all small cap stocks. You want to be a little bit safer, do all large cap stocks, which is like the major companies. So that's the market capitalization strategy. You buy it based off of the cap size. Another common one is number 8, which is the dividend growth. Dividend investing is more known as income investing or yielding investing. And this is how people get that income from the stock market. A lot of companies pays dividends either quarterly, annually, or like monthly. And if you put enough money in there, they'll start paying you like hundreds of dollars every quarter just for owning their company. And some companies, I believe, are legally obligated to pay dividends. Like I want to say, I believe real estate companies, if I'm not mistaken. So like Old Realty and like Zillow and stuff like that, they have to pay a dividend. So they're giving out dividends like every month. So I own a stock for $40, and for each stock I own of it, it pays me 25 cents a month. So then what I do is that 25 cents I put directly back into the stock. Right? It doesn't even hit my account. It goes directly back into that stock. So then imagine I have enough money in there, so instead of me getting 25 cents, all my stocks are equaling up to $40. So now every month I'm getting $40, and the stock is worth $40. So pretty much every month that stock is giving me another share, and I'm getting another share every month, and it just compound interest. It'll keep building up, and I don't have to put no more money in that stock because it's just paying itself and building itself for me. And then what a lot of people do is when they get enough money in there, instead of just having to reinvest, they pocket that money. So now they're making $1,000 every 3 months off of this company, and then another company is paying them another $1,000 a month on a different 3-month cycle. So they're just getting paid by the stock market every month by owning certain companies. They have a thing called dividend aristocrats. If you want to write that down, these companies pays dividends consistently over the last 50 years, I believe. And they raise their dividend as well. Not only do they pay them, they raise their dividends. The thing about dividend growth investing though is the stock may not grow that fast. So if it was at $40 this year, 2 years it might be $42. So don't expect like a huge growth rate in it. I'm not saying it's not gonna grow, but for the most part, they're real slow growers. Their money is through the dividend process. But if that stock grows and you're getting dividends, I mean, that's a double whammy right there. Number 9 is momentum investing. It's similar to the growth investing, but they're just riding a wave in a sense. The stock been going up all year. They'll jump on it and they'll ride it when it's going up. As soon as it starts to come down, they'll sell it. So they're just following the trend. If the stock is going down, they're going to bet against the stock, which is called short selling. So they're just riding the wave. If the stock goes up, they're going up. If it's going down, they're going down. That's the momentum investing. And then the multi-asset investing is pretty much diversification. You're doing some of all of this in your portfolio. You might have some companies that you're just going to buy it, and you're just going to keep buying it, and you're never going to sell it. You might buy some small caps, some large caps. Some of them might be some dividend plays. Some of them might be some value plays and some growth plays. But the multi-asset investing is just combining different stocks, different asset classes into one. So that way, if you don't want to be all into one sector. Say for instance, all of your money is in healthcare, and then one of the presidents sign a bill that affects healthcare. That whole sector is going to go down. If all your money is in healthcare, your portfolio is going down. But if you have healthcare, then you have like e-commerce and automobiles and technology, you might go down a little bit, but you have the other sectors that hold you up. And it's the same with market cap as well. You can do the next slide.
So that's like following the principle of the EFT form.
Yes, ETF. But you'll be doing your own ETF.
Right.
Yeah,
Okay.
in a sense. So when you're about to buy a stock, you're going to see this pretty much any brokerage you look at. And just to explain what it's saying, it says previous close. This is for the S&P 500 on Friday too, by the way. Previous close is at $505.03. That means when the stock market closed at 4:30 p.m. the previous day, it was at that price. Doesn't mean it's going to open up at that price. On open, that means the day today when it opened. So I did this yesterday. So previous close would have been Thursday night's close, and open would have been Friday morning's open. You see it open up extremely higher than where it closed at, because there's some brokers that allow you to trade overnight and like earlier in the day, depending on which broker you have. So it opened up at $511.16. The bid is what buyers are willing to pay for the stock. So the buyers, looking at this right here, kind of have the chart up there. The price of the SPY is probably at $512.31. So the buyers want to buy it for $512.30, and the sellers want $512.32. So that's what the ask is what the willers are willing to sell it for. And then if you see the little X and then the number behind it, that's how many shares they're trying to get. So they're trying to get 800 shares for $512.30. And then the seller wants $512.32 for 1,400 shares. Right? The day's range is how much that stock moved within that day, from 9:30 a.m. to 4 p.m. And you can see it went from $508.56 all the way up to $512.55. That's how much it moved in that one day. The 52-week range is how much it moved within a year. 52 weeks in a year. So from today to 52 weeks back, It went all the way from $408.87 to $524.61. With that, you can see if you're close to the highs or not. You can see the highest it went was $524. We're at $512. So yeah, you're buying it kind of high right now. The volume is the number of shares that's being traded today. And then the average number of shares is how much shares are traded on any given day for this stock. So if you see a high volume, there could be something going on there. If you usually see 71 million shares being traded, but today it's like 100 million, the stock could be skyrocketing or it could be dropping really fast, depending on that. Next slide. We're almost done, I promise. So right here, this is your risk level. The lowest risk is cash and cash equivalents. So that's your cash in your pocket, in your wallet. That's having money orders, cashier's checks, checking accounts. Virtually no return on it. But your money's safe. It's in your pocket, it's in your bank account. So bank account is mostly safe, but it's safe. Then the blue, you have money market accounts, high yield saving accounts, which rates right now are roughly around 4.47% for those. Varies between providers. You got certificates of deposits, which are CDs, which are around 5.36%. U.S. Treasury bonds, which are roughly 4.6 to 5.4% return, right? And that's above the cash equivalent and the cash risk. Above that is a yellow. That's what we're talking about today. And that's real estate. That's the equity mutual funds. That's the large and small cap stocks. That's your high income bonds and high income debts. Right? That's a little bit more risk than putting them in a CD, which is pretty much a guaranteed return. So these up here are not guaranteed returns, but on average, when it does return, it's higher than a CD account. Right? And then the very top, the red, that's the options, which we're not covering that today. I do those, but this is an introductory class, so we'll leave that for another time. There's futures, there's collectibles, and there's cryptocurrency, right? And those are high risk, high rewards. And the rewards are high, but the risk is high as well. It's really high risk, high rewards.
Yeah, didn't they kind of like went down one time?
They did.
Bankrupted or something?
A brokerage did. There was a guy who was pretending to be a crypto broker, him and his girlfriend, and somehow, some way, they got a lot of celebrities to join on board, and they promoted it, and he had no idea what he was doing, and lost a lot of people money. He's in jail too. Yep. Sam Bankman-Fried was his name. That happened like last year, I think. But cryptocurrencies, it's a way to go for real. A lot of people, a lot of millionaires are being made off of cryptocurrency, but it's really risky.
And it's a short-term risk, or
It's an all-time risk. I have a lot of money in cryptocurrency, and I've made a lot of money, but it's 24/7, first of all. You can trade at any time of the day, any time of the night. But with the stock market might drop 10% on like a bad month or a bad 3-month span. Crypto will drop 10% in 2 days, a day sometimes. But then it'll gain like 15% in a day at the same time. So the swings are a lot more volatile than the stock market. So that's why I say it's high risk, high reward. especially with
So
crypto.
you have to keep your eye on that.
Yeah. You will really have to learn the cycles,
Okay.
because there's going to be a cycle where it runs up really high, which we're almost in that period right now, and then it's going to crash really low. And then it's going to be low for like a year or two, and then that's where the accumulation phase is, where people are just, loading up on it, and just getting ready for the next run-up
You
phase.
say loading up, you're buying,
Just buying.
buying it, okay,
Yep, and waiting for the next run-up phase.
okay.
But if you're not aware when the cycles are, you could be buying your shares at the very top and then waiting for it to crash again, and then you're stuck holding the bag. Yeah.
So do the brokerage firms, like the Fidelities and the bigger companies, do they deal with the cryptocurrency, or is that a separate entity altogether?
It's in the process. A lot of them don't deal with it. But you have spots like Crypto.com and Coinbase, and a lot of the newer brokerages, the younger ones, they do allow you to buy crypto on there. But they did pass a law so that way there's a Bitcoin ETF. So that way you can buy into their ETF through your portfolio rather than just buying the actual Bitcoin. But a lot of the younger brokers, they do allow cryptocurrency trading. A lot of the older ones, they don't have it because it wasn't regulated, and it's still not regulated, but they're in the process of regulating it. That's why they approved the Bitcoin ETF.
I'll talk to you later. I don't know how that works, 'cause I was trying to purchase something online, and then they was like, they accept Bitcoin only. I'm like, I don't have that.
Yeah.
That's the scary thing about it.
So they're trying to make it cryptocurrency a universal form of payment. Because not everywhere accepts the US dollar. Not everywhere accepts the yen or, the pesos. But cryptocurrency can be accepted anywhere in a sense. So they're trying to make it like a uniform global payment transfers in a sense.
How does my dollar change into that?
The same way you can put it into the stock market, you put it into that. You have to go through crypto brokerage in a sense. Right.
So I'm gonna just ask a question. Are you a crypto broker, or have access to?
I'm not a broker, but I do have crypto portfolios.
Okay, we'll talk after.
Okay. And crypto's next slide. Crypto's is something. I remember when I was in high school, Bitcoin was $18. Somebody here in Jacksonville made the very first purchase with Bitcoin. They bought a piece for $20. That same amount he spent would have been like $200,000 today. It went from being $18 per coin to $68,000 per coin at one point. I think right now it's about $55,000 per coin for Bitcoin. So there's money to be made in crypto, but it's like you gotta know the cycles. Yeah, it's risky. Tips for success. Separate your emotions from trading and investing. Like we said earlier, your money doesn't care anything about you. Those presidents are dead. Separate the emotions. If you set a trade or you invest some money and you're emotionally attached to that, you may have put too much money into that investment. Right? So separate your emotions, because it's horrible. Me as a trader, I traded emotionally, and I've lost every time I went in there with emotions. But once you just do it like systemically in a sense. Just I'm gonna buy here and sell here. Don't think nothing of it. Profitable almost every time. But when you start to get emotional about the money and get attached to companies, that's how you start to lose money. Right? Have a plan for each trade, each investment. I'm only going to buy it when it hits a certain rate, a certain dollar amount, or with this dividend one, I might just continue to buy every paycheck. If it hits this price, I'm going to take some profit. Always have a plan, unless you're going with a financial advisor, they're going to do it for you. Then y'all can come up with a plan mutually together and what's best for you. Keep track of your portfolio. If you do it yourself, it'll show you how much you have in there, how much you've made that day, how much you've made since you opened the portfolio. And some of them will show you how much you made year to date. Right? Keep up with it. It'll show you how much each stock individually has made that day, how much you've made or lost since you've owned the stock. So just keep track of that, keep looking at it. It don't have to be every day. It could be once a week, once a month, depending on your strategy. If it's a buy and hold, maybe once every 3 months, just take a look at it, but still put money into it though. I'm not saying don't do that, but diversify. It's always your friend. You don't want to be heavy in one sector, because like I said, if that sector goes down, your whole portfolio goes down. So you want to have different sectors, different cap sizes. Yeah. Right, gotta have them 4 legs on the floor. 'Cause if not, you swipe that one, you're done. But when I first started out, I had, this on my YouTube channel too, I had went in with penny stocks, marijuana stocks to be exactly, because they were talking about legalizing it. And I was like, well, this is a chance to piggyback off of them. So I put $50 in, and I made like $500. I took it out, and I put it in more penny stocks. No real companies, no Amazon, no Google, just more penny stocks. I've never heard of these companies before. And they all crashed. They all went to zero. My account went negative $60. I was like, how did this happen? So I stepped back. I grabbed a lot of books. I read, I taught myself on it, and I came back with a different mindset towards investing, towards money, and I've been doing good since then. Dividends. Reinvest your dividends and your profits. So like I said, my dividends I make, it automatically goes right back into the stock. It's called DRIP, Direct Reinvestment Program. A lot of brokerages, they offer that. If you don't have it on, whatever money you make, they're going to put it right back into your cash bank with them. You have to transfer money from your bank account to them. So they'll put it in that little bank so that way you can have ready for you to buy it anytime. But if you do the direct reinvestment program, they put that money right back into the stock. Right? Don't be afraid to take profits. You might make some money off of these stocks. Take some money off the table. I bought a stock at $6. It went to $18. I took all my money back out. I left their money in there. So all the money that's in that stock is the market money. That's somebody else's money. I'm gonna let that do what it's gonna do, but I got my money back out. So you can't be afraid to take your profits. And when you take your profits, maybe put them into one of your more solid companies, like a Google, Amazon, Apple, whatever your portfolio has. You put into one of your more solid plays. Don't be afraid to dollar cost average. Dollar cost average may be you bought the stock at $10. Great company. Let's say Apple is at $100. You buy it. Apple drops to $70. Buy it again. Now your price is at what, $80-something? and then you just keep buying it, and your price is gonna average down. And then sometimes the stock might go up, but it's still a great company. You can still buy it as it's going up to raise your price, but you have more money in there to make more money, right? So don't be afraid the dollar cost average.
When you're doing that, are you still on the drip?
Yes, the drip
You're
doesn't
still
stop.
on the drip. When you, okay.
Yeah, it's just buying more shares. Because the stock market, a lot of people seem not to like discounts in the stock market for some reason. You hear a lot of people say like, stock market risky, man. The stocks is dropping. You losing money? I mean, it's time for me to buy more stocks. If somebody had 100-inch square TV, right, flat screen, curved TV, surround sound for $10,000, but that's expensive. They said we give it to you for $500. Okay, that's a deal now. It doesn't drop the price. But when the stocks are at $200 and they drop to $150, people losing money. Yeah, but it's still a great company. Amazon's still shipping out boxes every day to people. I mean, the market, it's a bad time for the overall economy. Now, if Amazon said we're not shipping boxes no more, we're gonna start focusing on karaoke only. Okay, then now the company's changing. Now we gotta reinvest. But if they're still the same company and nothing's changed, then why not take that $50 discount off of the $200 and buy even more? Because it's more than likely companies like Amazon are gonna go back up. They have like the shipping, they have the cloud network, they're doing AI stuff now. So it's like they have so many things. So if the company hasn't changed their core values and they dropped in price, then why not buy more at a discount? If it changes its core values, then you need to reinvest. Do you still want to own that stock? Do you still want to own the karaoke Amazon? Or do you want to put your money somewhere else at that point? And another thing that was hard for me to understand, if you lose money in that stock, you do not have to get it back in that same stock. So if you lost money in Apple, you don't have to necessarily get it back in Apple. There's thousands and thousands of stocks, right? Apple might be on a decline. A lot of people buy and hold Apple, but a stock might be on a decline, but another stock could be running up the last 6 months. So it's like, all right, I lost some money here, but this stock is making money. I can put my money into this movement, gain money here, let that one bottom out somewhere. Once that one falls to a floor and found a level and it's going to stay at for a little bit, then I might revisit that stock. So yeah, if you lose money in a stock, you don't have to throw more money into it. I learned that about the psychology of a trader. A lot of people, when their stocks are making money, they sell all of it. Let me take the money I won. But when the stock is losing, and it's like a bad company, they're just throwing more money into it. Well, here, let me put $20 more in there. Let me put $20 more in there. Next thing you know, you're just throwing your money into like an empty pit. And you just continue to lose the money. But if it's a great company, I mean, it might be worth waiting till it drops and then put money into it. Those are my tips of success. Opening a brokerage account. Some of the user-friendly ones for the beginners are Webull and Robinhood. Both of those, they do have crypto in there. I think Webull has a separate app for their crypto. Robinhood is in that one. But with Webull, you can invest, you can trade, you can paper trade, and they have a learning section in Webull as well. So they teach you about topics and subjects in trading and investing.
They would scare me by their name. I think I'll probably go with mine too. Weebull, that sounds like y'all ain't playing.
was stealing from the rich and giving to the
Yeah,
poor.
yeah, okay.
Robinhood made everybody stop their brokerage fees. They was getting all the money from all of them. But stop apps like Robinhood put the middleman, the lower income and middle income, into the game.
Right.
They gave us a chance to make money. Robinhood is very user friendly, very beginner friendly. You've got options on there, trading cryptocurrency on there. I think Robinhood has a learning platform, but I know Webull does for sure. In the corner, that's my YouTube channel. I got shirts as well. I'll be selling my shirts. $15 a shirt. Huh? No, so this will be in another class. My next class is in August. But there's a bull market and there's a bear market. The bull market is when the stocks are going up. You might hear somebody say, I'm bullish on this stock, or I'm bearish on this stock. Bulls mean the stock market is going up. Bears think the stock market is going to go down. Because you can bet against stocks. And when it goes down, make money that way. So there's a term saying that bulls make money, bears make money, and pigs get slaughtered. Because if you're being greedy, you're probably going to lose all your money. And they're gonna have it, the bulls and the bears. Because they have plans. If you don't have a plan, and you just buying stuff, you're just giving your money to the market in a sense. So yeah, I'm gonna have a second class in August, which will be more in detail with the actual trading and investing, like showing the process of actually going in and buying a stock, and a look inside the brokerages. Do the next slide for me. As well, one of my longtime friends, him and his wife have a financial literacy class as well. They'll be speaking on some different topics than I spoke on. He is a financial advisor, and his wife is a mental health therapist, I believe. So they're going to be speaking on the money and mental health. That'll be next Saturday at 10 a.m. They're having a raffle on theirs. So if you want to join that, you can let me know. I'll send you the link so that way you can join in on there. Class is all virtual. It's a Zoom meeting. It's an hour long. And there's one more. So on this website right here, this is a website I set up today for paper trading for everybody. So you'll go to that website, you'll sign up with Facebook or through email, and
I'm sending it to you guys right now.
Jessica's sending you all the link. And with this, you will start off with $100,000. It's fake money, so don't get. I don't have it like that, y'all. So you're gonna start off with $100,000, and you're gonna have access to the live stock market. Though everything else is real. The stock market and the orders are gonna be real, and you'll be able to see your portfolio, what you're holding, how much you made, and you can see what everybody else is holding and what they made as well. And it'll rank us in order for who's in first place, who won the most money, who lost the most money. It'll rank us like that. It's like a game in a sense, a paper trading game. And it's going to be for 1 year. So it ends next April. So even if you have like teenagers or somebody who wants to get involved, you can send them that link. They can join our game. And it's really just to get you more comfortable. So if you want to do it yourself, you can get a look at what actual brokerage would look like when you start up.
Now, is that a pretty simple process? I mean, we need somebody to maybe help us understand
Yeah, if you click link, you can start it right now.